Investing can lead you to financial freedom, or straight into a trap that drains your hard-earned money. It can feel like you're walking a tightrope, with the potential for massive rewards on one side and the risk of devastating losses on the other. Today, we're uncovering the red flags you need to watch out for in investments, and how to avoid them so you can keep your path to success clear. Red flag number 1. Guaranteed high returns. This is often the first sign that something might be amiss. Let's face it, nothing in the world of investing is 100% guaranteed. The stock market, real estate, commodities, they all have their ups and downs. If someone promises sky-high returns without risk, you need to be extremely cautious. Such promises are often too good to be true and can lead to significant financial losses. It's crucial to remember that every investment carries some level of risk, and anyone claiming otherwise is either misinformed or trying to mislead you. Risk is an inherent part of investing, and understanding this is key to making informed decisions. Think about it. If someone actually had a foolproof way to generate massive returns, why would they be sharing it with you? Wouldn't they be keeping it a secret and using it to build their own wealth? Wouldn't they be keeping it a secret and using it to build their own wealth? The reality is, those who truly understand the market know that there are no shortcuts to success. The truth is, legitimate investments come with a degree of uncertainty, and anyone promising otherwise is likely trying to lure you into a scam. Scammers prey on the desire for quick and easy money, but falling for these schemes can have devastating consequences. Now, this doesn't mean you should be scared of every investment opportunity that comes your way. Instead, approach each one with a healthy dose of skepticism. Do your research, ask questions, and seek advice from trusted financial advisors. Instead, approach each one with a healthy dose of skepticism. Ask yourself, what's the catch? What are the potential downsides? And most importantly, does this investment align with my overall financial goals and risk tolerance? Ask yourself, what's the catch? What are the potential downsides? And most importantly, does this investment align with my overall financial goals and risk tolerance? These questions can help you navigate the complex world of investing and avoid falling victim to scams. What are the potential downsides? Every investment has its pros and cons, and understanding these can help you make more informed decisions. And most importantly, does this investment align with my overall financial goals and risk tolerance? Your financial goals and risk tolerance should always be at the forefront of your investment decisions. Remember, if it sounds too good to be true, it probably is. Always be cautious and take the time to thoroughly evaluate any investment opportunity before committing your hard-earned money. Next up is lack of transparency. If a company or investment fund isn't open about how they generate returns or where your money is going, that's a huge warning sign. Transparency is crucial in the investment world. You have every right to know exactly where your money is going and how it's being used to generate returns. If a company or individual is hesitant to provide this information, or if their explanations are overly complicated and difficult to understand, it's a major red flag. Think of it like this. You wouldn't hand over your life savings to a stranger without asking any questions, would you? The same principle applies to investing. You need to do your due diligence and make sure you're comfortable with the level of transparency being offered. Look for investments with clear, concise, and readily available information about their strategies, fees, and track record. Don't be afraid to ask questions and demand clarification on anything that seems unclear. Remember, it's your hard-earned money on the line and you deserve full transparency. Too much leverage. Red flag number 3, overleveraging. While leverage can boost returns, too much of it is a ticking time bomb. Now, leverage can be a powerful tool when used responsibly. It allows you to amplify your returns by essentially borrowing money to invest. However, just like with anything else, too much of a good thing can be dangerous. Over-leveraging or taking on too much debt to finance your investments can magnify your losses just as easily as it can amplify your gains. Imagine this. You invest $10,000 in a stock and it goes up 10%. Congratulations, you just made a cool $1,000 profit. Now, imagine you used leverage to invest $20,000 of borrowed money alongside your initial $10,000. That same 10% gain would now net you a $3,000 profit. Sounds great, right? But here's the catch. If the stock goes down 10% instead, you'd lose $3,000 instead of $1,000. The key takeaway here is to use leverage cautiously and strategically. Don't let the allure of amplified returns cloud your judgment. Carefully assess your risk tolerance and never invest more than you can afford to lose. Remember, slow and steady wins the race when it comes to building long-term wealth. It's crucial to understand that leverage is a double-edged sword. While it can enhance your profits, it can also lead to significant losses if not managed properly. One of the most important aspects of using leverage is knowing when to pull back. Market conditions can change rapidly, and what seemed like a good investment yesterday might not be so today. Setting stop-loss orders and having a clear exit strategy can help mitigate potential losses. Always have a plan in place for different market scenarios. Diversification is another key strategy. By spreading your investments across different assets, you can reduce the risk of over-leveraging in a single area. Balancing your portfolio with a mix of leveraged and non-leveraged investments can provide stability and reduce overall risk. Staying informed about market trends and economic indicators can also help you make better decisions about when and how to use leverage. Continuous education and seeking advice from financial experts can further enhance your understanding and application of leverage. Ultimately, the goal is to use leverage as a tool to grow your wealth without exposing yourself to unnecessary risks. It's about finding the right balance and making informed decisions. With careful planning, strategic use of leverage, and a focus on long-term goals, you can achieve financial success while minimizing potential pitfalls. Remember, leverage is just one of many tools in your financial toolkit. Use it wisely, and it can help you reach new heights in your investment journey. Following the hype. Another major red flag is chasing hype investments. Whether it's meme stocks, hot IPOs, or the latest crypto coin, following the crowd can lead to disaster. The allure of quick profits can be tempting, but it's important to remember that these investments are often highly volatile. It's easy to get caught up in the excitement of a hot new investment trend. The media often amplifies this excitement, making it seem like a sure thing. You see everyone around you making money, and the fear of missing out becomes overwhelming. You don't want to be left behind, so you jump in without fully understanding the risks. But here's the thing. By the time an investment becomes mainstream news, it's often too late. The initial surge has already happened. The early birds have already made their profits, and the market is now saturated with latecomers. You're left holding the bag when the hype inevitably dies down, and the value of your investment plummets. Remember, investing based on emotions is a recipe for disaster. Emotional decisions often lead to buying high and selling low. Just because everyone else is jumping on the bandwagon doesn't mean you should too. Herd mentality can be dangerous in investing. In fact, it's often a sign that you should be extra cautious. When everyone is rushing in one direction, it might be wise to take a step back and reassess. Instead of blindly following the crowd, take the time to do your own research. Look beyond the hype and examine the underlying factors. Understand the fundamentals of the investment, assess its long-term potential, and consider the risks involved. Make sure it aligns with your overall investment strategy. Diversification and a well-thought-out plan are key to long-term success. Consulting with a financial advisor can also provide valuable insights and help you avoid common pitfalls. Don't let fear of missing out or FOMO lead you to make rash decisions. Stay disciplined, stay informed, and always invest with a clear mind. Illiquidity. Finally, let's talk about illiquidity. Investments you can't easily convert to cash when you need it. Illiquid assets like real estate or private equity can tie up your funds for years. Liquidity refers to how easily you can buy or sell an asset without affecting its price. Liquid assets, like stocks traded on major exchanges, can be bought and sold quickly and easily. Illiquid assets, on the other hand, can be difficult to sell quickly and may require you to accept a lower price to find a buyer. While illiquid assets can offer potentially higher returns, they also come with greater risks. If you suddenly need access to cash, you might be forced to sell your illiquid assets at a loss. The key takeaway here is to carefully consider your liquidity needs before investing in illiquid assets. Make sure you have enough liquid assets to cover your short-term financial obligations and emergencies. Illiquid assets can be a valuable part of a diversified portfolio, but only if you understand the risks involved. Avoiding these red flags will save you from a world of financial pain. Imagine the freedom, making smart, informed investments that work for you. No stress, no traps, just sustainable, long-term wealth. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions that align with your financial goals and risk tolerance. By being aware of these red flags and approaching investment opportunities with a healthy dose of skepticism, you'll be well on your way to building a secure and prosperous financial future. Success is about being vigilant, smart, and patient. Steer clear of these red flags, and you'll be on your way to living your dream financial life. If this video helped you spot the red flags, make sure to like, subscribe, and share. Stay informed, and let's build that financial future together.